Hello and welcome back to Financial Future, your source for all things related to the world of finance and investing. In today's video, I want to share some important insights with you about the current state of the stock market and what it means for your financial future. As you may have noticed, the stock market has been experiencing a bit of turbulence recently, and there are several key factors that are influencing this downward trend. Let's dive into the details. First and foremost, it's crucial to understand that the stock market's performance is primarily driven by three key factors: hype, corporate earnings, and monetary policy. While other factors do play a role, these three are the primary drivers of stock market movements. Now, let's talk about the hype factor. Hype can have a significant impact on the stock market, and in recent times, there has been a lot of hype surrounding artificial intelligence and its potential to revolutionize the economy and boost stock prices. However, as we've seen, this AI hype has gradually faded away, and the promised revolution hasn't materialized as quickly as expected. It's essential to acknowledge that real change often takes more time than the initial hype suggests. Another hype that has dissipated is the expectation of the Federal Reserve cutting interest rates in 2023. Initially, it was anticipated for July, but now it's been pushed further into the future, and the media is finally admitting the likelihood of higher interest rates for a more extended period. I've been consistent in my prediction that the Federal Reserve wouldn't cut rates in 2023, and I still stand by that, even with 2 more meetings this year. Now let's shift our focus to the corporate earnings aspect, which is a major driver of the stock market. Corporate profits have been on the decline for the past 9 months, with 3 consecutive quarters of declining profits. While it's still early in the reporting season, about 20% of S&P 500 companies have reported earnings, and they're showing a 0.4% decline in profits on average. More companies are issuing negative guidance, signaling a challenging outlook for corporate profits. This trend, as indicated by the companies themselves, is concerning and has the potential to put downward pressure on the stock market. The Federal Reserve of Atlanta is projecting a strong GDP growth rate for Q3, which seems great on the surface at 5.4%. However, it's essential to look beyond these numbers and consider the financial health of households, which is not keeping pace with GDP growth. Delinquency rates and defaults are increasing, which suggests that the positive GDP growth might not translate into immediate benefits for the average person. I should mention that, on paper, the stock market doesn't appear to be overvalued at the moment. The forward 12-month P/E ratio on the S&P 500 is in line with the 10-year average. However, it's essential to keep an eye on Q4 guidance, as analysts often revise their projections lower as we approach earnings season. This can create a situation where companies beat lowered expectations, but the stock market reacts negatively. Lastly, let's talk about monetary policy, which is a significant driver of the stock market. The Federal Reserve plays a pivotal role in shaping monetary policy, and it's important to understand that the U.S. economy is not governed by free markets. The Federal Reserve exerts substantial control over the economy, and their policies have a direct impact on the stock market. The recent tightening of monetary policy, including the Fed funds rate increase and quantitative tightening, is worth monitoring. QT, in particular, is like a slow poison to the stock market, as it reduces liquidity and makes it challenging for stocks to perform well. Additionally, as the 10-year yield crosses 5%, the competition for capital between stocks and higher-yielding government bonds can lead to stock market challenges. The Federal Reserve's intentions and actions in the coming months will play a significant role in determining the stock market's trajectory. So, in conclusion, it's essential to keep a close eye on these key factors: hype, corporate earnings, and monetary policy. While I cannot predict the future with absolute certainty, understanding these drivers can help you make more informed decisions regarding your investments. Don't be swayed by media hype and remember that the Federal Reserve plays a vital role in shaping the economic landscape. Thank you for tuning into Financial Future, and I appreciate your continued support. Please subscribe to stay updated, and as always, I look forward to helping you navigate the ever-changing world of finance and investing. Happy investing, and until next time,